All right, welcome back to Yahoo Finance Live. Miles London here in New York. We're joined now by Andy Richman. He is the Director of Fixed Income at SunTrust Advisory Services. So, Andy, we've talked so much on this program, as we do most days, about what's happening in the stock market, focusing also, of course, on the oil market. You're focused on fixed income, and we've seen, obviously, the beginning of this sell-off, huge moves across the Treasury curve. The Fed came in with all kinds of different programs, but by Fed standards, it's been pretty quiet for the last couple of weeks. So, with maybe a chance to catch your breath, what do you see as the state of play right now with what the Fed has done, what's working, and what maybe they need to do next?
Sure. Yeah, they certainly did a lot. Obviously, they first stepped in on the short end of the curve, bringing rates down to zero, helped stabilize the short liquidity side of things where we saw dislocations on the repo market in particular. And then recently, right before Good Friday, as the market closed, they really came out and put out a number of facilities that were really, firing a pretty big bazooka. And what they're doing, and they still haven't done it yet, but what they can do and will do is buying corporate credit outright now, both in the primary and secondary markets, out to 5 years. That's all investment grade rated securities, and they can even buy securities that were investment grade as of March 22nd. So compared to what they did in 08 and 09, they're really stepping up a lot more here. That really calmed markets down. We saw high yield and investment grade credits really blow out. Before that, they've come back quite a bit since then. They're still, to us, look attractive in some plays, but certainly added a lot of stabilization to the fixed income markets.
And you mentioned how much faster they moved than we saw during the financial crisis, and I think obviously that's a learning from that period of time. I guess the question now is, as someone who's following fixed income and what the Fed does, what do you like? How are you thinking about this next phase of monetary policy history? I mean, I don't think talking about higher interest rates is going to be part of the conversation for years and years and years. But as these programs evolve, I mean, how long is this all-out emergency setting, do you think, going to be in play for? How does the Fed even begin to maybe wind some of these facilities down? Because right now we're only starting to understand, if they work to kind of the fullest extent the Fed hoped.
Yeah, those are all good questions, Miles. I think now they're actually going to just keep ramping them up. Or the balance sheet on the Fed is up to $6 trillion. Estimates could go 9 or 10 trillion to that, which are, again, paling in comparison to what happened in 08 and 09. So remember, the pushback then on the TARP plan and buying treasuries and mortgage-backed securities was unheard of. Now they're buying corporate bonds, and even exchange-traded funds that are made up of corporate bonds are eligible. So a lot more done. I think that the roll down is going to take a while. I think you're right. I think rates stay at zero for the foreseeable future, at least 12 months, if not longer than that on the short end. The ramifications are interesting, right? The Fed's going to have to issue a lot of debt. They're building out their balance sheet. Right now, as you heard earlier, deflationary pressures and disinflationary are the theme, and I would agree with that. But eventually, does this bring on some type of inflationary pressures? And that's a longer-term problem. I think the Fed would love to have that. Right now, that balance sheet's going to get ramped up and maybe slow down, I think, the ramp up by the end of the year. But certainly, it's going to be high for a long time and get higher from here.
Given the new world order that both you and Miles have sketched out, and the fact that we have a whatever it takes commitment from the Fed, I'm curious how it's changed what you think about risk in this market and what you talk to investors about risk. If you have a Fed that says they're going to do whatever it takes, how does that change your thinking around risk?
Yeah, it's a good question. Obviously, risk is one of the biggest things we look at in fixed income, right? Return is always going to be relatively low, and it's for fixed income, especially for our investors, controlling risk is really important. And for us right now, I think following the Fed in that investment grade area, 1 to 5 years on the corporate side, looks like a good play for us. So that's where we'd be focused on. But I balanced it out because when we saw those dislocations in the market, we saw corporate bonds blow out. We saw munis move faster and wider than we've ever seen that happen, which looked like a stable asset class. So what I think it tells us is, well, corporate bonds are attractive. There's room for muni bonds. You still want to have some government bonds as a ballast in your portfolio during these rocky times. So even though yields are paltry and going to stay paltry, again, if you're really looking to control risk, I think you want to be even more diversified and up in quality right now.
And then I guess, Andy, kind of following up on Jen's question, and we don't know for sure, but one imagines that the shape of the corporate debt market is going to be remade after this, considering how the Fed stepped in and which companies were able to handle their debt loads, which weren't. Do you start to get any sense now of what the corporate debt market and the corporate debt world, whether it's from the private lending side, the secondary market, how that all might look as things start to thaw a little bit? I mean, that market's been frozen pretty much for the last 6 to 8 weeks. But is there any sense of what the corporate debt market might look like as we try to get things going? And companies are trying to stay in business. They're going to have to issue debt to continue over the next year.
Yeah, it certainly was. You're right. It was frozen for a while. I'll speak to the public debt side, and certainly we're seeing corporations come with new issues, and there's been a pretty good demand for that where they couldn't come. So I think the Fed did their job in opening that up. So I think you will see the ability, especially in that 1 to 5 year space, on new issuance happen. The muni market, the Fed's still got some room there, right? They can go by 24-month directly from the issuers, but they really haven't opened it up as much there. So that's one area I think that could still have some ability to move on. But certainly I think it's thought out the investment grade market. The spread went up to almost 400 basis points. It's down to 200 now. We've seen a big recovery. But the private market still, I think there's some pitfalls there. A lot of lending got pushed there, and I'd be still a little bit cautious on the private lending side, at least in the short run.
All right. Andy Richman is the Director of Fixed Income at SunTrust Advisory Services. Andy, always good to talk to you. We'll talk soon.
Thanks, Miles.